Hey guys, welcome back to the channel. This is the Capital Mindset Show. We're your hosts, Austin and Fabio, and we're doing something new here today. We're calling this Fabio. What are you buying today?
So basically today, what I bought a big amount of, or a decent amount of, is a company called Aerojet Rocketdyne Holdings. And so what we're going to do here is Austin's going to pick my brain as to why it is I made this investment, and what are my projections, where am I buying, where am I getting out, if they even have answers, because sometimes those things are undetermined at the filming date, but we'll see.
So Fabio, first and foremost, what's on everybody's mind, what is the company itself that you bought into? And then also kind of a brief overview as to why you bought this company.
So basically a quick brief overview, and we'll actually put that on the screen now about this company. It's a business that develops rocket technology and sells it through multiple peripherals. So that could be, I think they just landed a deal with NASA for about just over $1 billion in their order backlog. And it's a fairly small business. It's about $3 billion in size. When I say small, I mean small compared to the larger players such as Boeing, Raytheon, and the others in the aerospace industry.
So basically kind of piggybacking off that, what were some indicators that you saw that you were like, this is definitely a company I want to put my capital into right now in this very moment?
Yeah, so in the market, sometimes you get rare moments of opportunity, I believe. And it's not often, but sometimes you can play these moments of arbitrage. And in the case of AJRD, which is the ticker of the business, they are being acquired by Boeing for about $51 a share. Ooh. And currently the business is trading at around $42 a share. Now, the reasoning behind the price drop, if anyone were to bring out the chart, and we'll actually put the chart right now, real quick for everyone to see, is there were some rumors that the deal would not be allowed through by the FTC. So once you saw that initial run up, it came right back down based on those rumors. But more recently, we've been hearing some chatter from both the Pentagon and members of Congress, a bipartisan group, to allow the deal to go through in accordance with the furthering of national security. So while prior to these announcements, I was not skeptical, but I just knew of the deal that was going through. In order to catch these things before the run up, you have to have a crystal ball, which none of us do. So what I tend to do, and I've played a lot of these with, such as TD Ameritrade when they got acquired by Charles Schwab, and I played it a little bit after the news was announced, and more successfully was E-Trade and Allergan. What with these kinds of opportunities is sometimes you can have a moment where the deal, there can be skepticism surrounding the deal, and you might get a pullback. And then if you personally take a look at the deal and you actually think it will go through despite the skepticism, it could present an interesting opportunity. Now, it depends on the assumptions you make on the back end, such as the actual value of the business, to kind of determine what your downside is, because that's basically what a lot of investing is. It's about the risk reward and hedging your risks, not taking on too much risk. Remember, rule number one, don't lose money. Rule number two, don't forget rule number one. So with this business, we saw that the downside risk was fairly low at a maximum, we believe, of around 20%. But I believe it's going to be between that. So I'm giving myself a wide range on the downside if the deal ends up not going through. So about a drop to $33. And then if the deal goes through, it will be obviously $51 that I'll get.
So kind of piggybacking off of what you just said, Fabio, let's kind of open up the model now and just kind of show your thought process behind what went into your eventual decision to buy into this position, Fabio.
Okay, so we'll actually pull up the model right now. All right, so now that we're looking at the model here, let's go ahead and plug it in. It's AJRD ticker. Okay, so now let's go look at the key ratios first. So here we have open the first ratios. We have the liquidity ratios, and we see a good improvement here from 2020 to 2021, but kind of a deterioration here, but not too bad. It's still above 1. We want to see this above 1 because that tells us that the business can pay off all its current liabilities with its current assets. The cash ratio, it's okay. It's more or less stayed the same. It's an improvement again from 2020 to 2021. And again, just for everyone watching at home, we have right here on the right an indicator of what is better when it goes higher or lower. So total debt ratio here in the solvency ratios, we're going to see actually a lot of improvement. So we see improvement there. We see an improvement in the long-term debt ratio by quite a bit. That's actually really interesting. And the long-term debt to capital ratio, we also see an improvement as well. And then we also see an improvement on the debt to equity ratio. All these fantastic. Gross profit margin, we see kind of staying the same, a slight increase from 2017. Operating margin, same story. Net profit margin, same story. And we're in the realm of acceptance in the industry of the aerospace industry. And then we have return on assets. That's also an improvement again from 2017. 2017 might have been an interesting year for GAAP net income based on these numbers. But we'll take a look when we get to the cash flows as to what if that paints a better picture. And then return on equity, these numbers are actually frankly fantastic. And we see obviously an improvement. I'll take 2018 numbers in this case from 32 to 38. But okay, we can kind of get an idea of the rate of return they're getting on return on equity. So pretty good stuff so here.
Fabio, kind of taking a look at this here. Why do you think there's such a discrepancy between the current ratio and cash ratio? Is that just kind of the way the current assets are broken down?
Yeah, so normally you'll always see the current ratio be less than the cash ratio because the cash ratio is considered to be the most conservative ratio. It's literally just cash compared to the current liabilities. But recently, actually, I don't even think it's shown here perfectly. They lost a lot of cash because of the special dividend due to the acquisition by Lockheed Martin. So in reality, with the special dividend, the value you're getting out of it is $56. I believe the special dividend is $5. So $51 coming from Lockheed Martin buy price and a $5 special dividend that's going to come out. Now, when we take a look, I think we're done with these ratios. Do you have any other questions?
Yes. The gross profit margin, is this typically in this industry a gross profit margin we would like to see, Fabio?
Yeah. So with this industry, I like to see around 20%, around there, give or take. So a little higher, a little lower, but around 20%. Nothing too low. Like if I see a 10%, I don't like that. A net income margin of 10% is pretty normal, like Lockheed Martin has around there, and on a GAAP basis, not on a free cash flow basis. But yes, those margins are more or less what I like to see in this industry. All right, so let's look at the earnings quality. So earnings quality kind of tells us whether or not management is doing any accounting shenanigans for the most part. And what we can see here, earnings quality is actually pretty good. It's very good. So basically what we can see here to paint a bigger picture here is EPS reporting and then price to free cash flow. So free cash flow is consistently higher than GAAP net income. And this, for anyone that's wondering, is what we call an upside surprise. So over the long term, free cash flow and GAAP net income will reflect one another. But there will be moments where free cash flow is significantly higher or maybe slightly higher. But over the long term, they should more or less follow each other. So on a price to free cash flow basis, we can kind of get a feel for how cheap the company is. Again, this is 2021 over here. So this year's not even done yet. So we should probably focus more on 2020's number, and we can see the price to free cash flow is about 10, but we do see some fluctuation because here we went from 13 to 17. Here something probably occurred because they're making a free cash flow per share about the same. So this had to do with the price at the time. It was probably more expensive here than it was over here because there isn't much of an improvement. And then the free cash flow took a nice jump in 2020 to $4 from $2.82. Now this actually might be a one-time event, and then this might be normalizing. but that would require a deeper dive there. So actually, I would take this number and extrapolate that number to around here, and then make our conservative assumptions from there.
Mhm.
But even then, the price to free cash flow is fairly low.
Mhm.
And then,
And
the
then
book,
I've also heard you mention sometimes too, when it comes to book value per share, Fabio, that sometimes based on the industry, book value per share will sometimes show lower numbers, and that the price to book ratio that reflects will oftentimes be indicative more so towards an industry average. Is that kind of what we're looking at here?
well, for this business and this industry, I wouldn't focus too much on book value per share. The book value per share for the financial industry is more something that I would pay attention to, but for this industry, it's not something I would focus too heavily on.
Perfect. That was my question.
All right, perfect. So then now we're going to go into the final ratio. So this kind of tells us a lot about their inventory. So inventory turnover basically tells us how often do they go through their inventory. And from 2018 to 2021, we want to see an improvement, and we did drastically.
Mhm.
This is great. This probably coincides with more business that they're doing. And remember that they're in the aerospace industry, so there's a lot of tailwinds for this industry. And then days of sales inventory, we want to see this going lower. In fact, it halved, right? But again, we have to see the full year, but it looks like it halved already so far. This is incredible over here. Then asset turnover, we see more or less maintenance, so about the same. And then accounts revenue turnover, again, about the same. So it's not terrible, but not much improvement there. All right, so going to the model, let's get us a price target. Actually, let's take a look at return on invested capital. I think for this business, it's important. So what we can see here is return on invested capital is actually pretty high. And then we can see an average of 34.67. So 34.67%. And we can see the years we're seeing improvement from 2017, 2021. Okay, so this furthers my theory that 2021 was an anomaly.
2020. Yeah.
Sorry, yes, 2020 was an anomaly. I said 2021. 2020, something happened here where there was like a one-time cash inflow of some sorts, and they got a really high ROIC. But either way, a very high ROIC. So this is actually pushed a little bit higher, but because of that 60. Okay, so now let's take a look and get a value onto here. So
before we actually do this, Fabio, I have another question to ask you. Would you just recap again quickly the risks present with this and how that's influenced your decision to make a discount rate?
Yeah, so it's very important. So the risks with this business is the deal does not go through. So you're buying a business that soon will not exist. This business will become part of the Lockheed Martin family, and they will be paying $51 a share should the deal go through. The current price you can see is $42.92. And so that being said, the risk is mainly lying with the FTC's decision. However, underneath all that, there is a very solid business. And this is not one of my core investments. This is leaning more so onto the speculative side. However, not so speculative that it's a tiny minuscule position, right? There are understandable risks and measurable upside.
So now, Fabio, let's kind of go over positioning with this stock and what you did with it today.
Okay, so today I bought around $60,000 worth of this company, and I'll put the prices, screenshots of the prices, the times I bought, and the quantity I bought across different accounts. The only one that's missing there is my wife's account. You can kind of see where I'm going with this. It's actually, I bought between my retirement account and my non-retirement account. What the plan here is, if it were to rise to close to 51 based on the FTC approval, I will go ahead and sell at a profit, because regardless, I'm not going to get a long-term capital gains benefit. The profit that I'm looking for is around 20% on my capital invested. And if anyone's seen our previous videos or other videos on investing, you'll see that I usually require a 20% rate of return. So the upside actually matched my required rate of return. And actually it superseded it, because 20% in a couple months of waiting is actually a greater return than 20% over the course of a year. So if you annualize that return, it's greater than 20%. Now, for a discount rate here, I thought actually it would be appropriate to apply a 10% on the business because of the risks, but actually we can kind of get an idea of what a 15% discount rate would look like based on these growth rates. And you can see that at all these following assumed growth rates, the business is not a buy. That has to do more so with the current pricing, because it has gone up from its low of 33 more recently. We can take a look here at the pricing. So the pricing that I would like to get this business, if I were to invest for the really long term, would be $31. And if it were to not be a speculative position, which it is right now, let's be very clear on that. I would like to get this business between $31 and $23, because I'm fairly confident that the growth rate of this business will be between 5 and 10% going forward for the next 10 years. If I could get it at that price, then this is the price I'd pay for this business. It's a 15% discount rate and not a 20% discount rate, because this is a business I have a lot more confidence in as a quality business. There's a lot less risks with the management, with the performance of the management. So I'm fairly confident with that discount rate. However, again, because I am looking at it from the perspective of this acquisition, it is a speculative position, and I'm looking to make around 20% on the upside. And I actually would be fairly confident it could go down to 33 on the downside.
We hope that you've enjoyed what you've seen here today. If you have, be sure to like, comment, and subscribe, and visit our website, capitalmindset.org. We're your hosts, Austin and Fabio, and we look forward to seeing you guys the next time. Take care.